Happy New Year, everyone. Today, I'm going to talk about what my predictions for Oahu real estate are for 2023. I'm going to start big picture, and then I'm going to go into the specific items that I believe support my thesis. So let me start big picture. I believe that the cataclysmic end of real estate or demise of real estate is way overstated, especially here on Oahu. And in fact, at the end of 2023, we are going to have seen a flat market, maybe some incremental declines depending on where a property is and how well priced it is, or the condition of the property. But we're not going to see any cratering in our market. And the reasons are that we don't have enough supply. We have inflation, and we're going to talk about that. We're going to talk about an unstable world, and then we're going to talk about presidential politics. So here's why I believe our market is going to remain good, and we're not going to see any change. Supply and demand, economics 101 drives everything. In order for values to come down, we need a far greater supply of homes and condominiums for sale. We'll see condos build first, but the leading indicator are single-family residents. Now, we ended the year at 2.1 months of inventory remaining in the market. That actually dropped from the previous month of 2.2 months. We were on average 12 days on market. That's nothing. So 2.1 months is not a lot of inventory. It means all of our inventory is going to be gone if we stop taking listings today. And then it's only taking 12 days to sell listings that sell. Also, if you look at new listings coming online, they're dropping. I don't see the new listings coming online, or enough of them coming online, to be able to drive the days on market up, as well as drive the number of months of inventory remaining up. We've got to get up around 4 or 5 months of remaining inventory, and I don't see it happening. Here's why. 83% of the loans in the United States are 30-year fixed rate loans, which means that the average loan rate across that 83% is probably 3.5% plus or minus some. If we went out today to get you a new loan with no points, you're probably looking at 6% plus or minus something. And it's that differential that's creating the problem. If you have a 2.75% 30-year fixed rate loan, 2.75 30-year fixed rate loan, and your option when you're moving up is to go to 6%, you're not going to do it. And if you did decide to do it, there's going to be a delinking between the sale of your existing home and the new home that you buy. This week, I had 2 conversations with 2 separate homeowners where I recommended that they keep their existing home because they'll never see 2.6% in one case and 2.75% in another case. They'll never see that in their lifetime. And so we need inventory coming online. And without it coming online, and those interest rates will exacerbate inventory not coming online, we're not going to see the inventory build. Add to that here in Honolulu that we have the longest hold periods in the United States for single-family homes, so we naturally don't see homes turn over quickly or regularly. We don't have the inventory coming online. I'll give you an example. My home that I'm filming at right now was built in 1937. I'm the 3rd owner. I've owned it 22 years. The people that owned it before me owned it 53 years. Think about that. This home is only sold 3 times. And so our natural tendency in Hawaii to hang on to real estate is going to keep inventory down. All right? Number two, let's see, what's number two? The general economy. So let me throw all of this into number two. Stock market volatility, inflation, interest rates increase, and here's something that's interesting, cash chasing real estate. All right? So as a category, what does this mean? Do you know anyone, maybe you have had it happen to you, but do you know anyone that had lost money in the stock market last year? I know tons of people. And what we're seeing in my daily practice is people are tired of the volatility and they're concerned about inflation. So if inflation is eroding their equity that they might be sitting on, and so you're starting to hear people say, buy hard assets. Well, what are hard assets? Gold, silver, real estate. And the difference between gold and silver and real estate is that real estate at least has rental income in most instances. So we're starting to see investors come into the market with large amounts of cash buying real estate to rent out. Increased interest rates that we have right now has reduced the number of people that can buy, which has increased the number of people that are looking for rentals. And as a result, we're seeing rental rates go up. So hear me out. If investors are looking for rental properties for cash flow and rental rates are going up, increasing the return on investment if you buy rental properties, what's going to happen to rental property values? Might they go up? Interesting. What we're seeing now with the volatility in the stock market, with increased interest rates, with lack of surety throughout the economy, is people are looking more for stability than they are looking for return on investment. And so we're seeing investors chase real estate. People are looking for stability, all right? Now hear me out. The U.S. is going to start looking more and more stable in an unstable world. Let me explain. Have you heard of something called the Ukrainian war? Is that part of the world stable or unstable? If it happens to expand to Poland or to other Eastern European nations, the rest of the world starts to look unstable. Question for you. Has China been rattling its saber or sabers with regard to taking back Taiwan? They have. You've been paying attention to the news. And they want to take Taiwan back. We have a weak president. That's my opinion, right? Weak president. They may see this as an opportunity to go in and take Taiwan back. Because of that, think about this. For the first time since World War II, Japan is building up its military forces. In the article that I read, it's because they're concerned about China and its overtures, military overtures in the region. Think about that. So in a world that's looking unstable, all of the money in the world, in this interconnected world that we live in, may be looking for a stable place to go, and that would be us. Could foreign capital start coming into the United States at significant levels where it starts impacting inventory and prices? We'll see. Now, again, my prediction is flat prices, maybe incremental declines. But could we see, if enough people came into the Honolulu market buying as hedges against instability in the world or an unstable world, could we see that impact our market? Yeah, I think we could. We have 597 single-family homes for sale at the end of 2022. If 50 outside investors came in and bought houses here on the island of Oahu, we've just reduced inventory by 10%. Would that have an impact? 100% it would have an impact. So think about those outside sources, what's going on in the world, and how the United States, even though we have problems right now, looks stable as compared to the rest of the world. Finally, we have 2024 coming up. And I believe the first half of the year, they're going to allow things to play out. But as we start getting closer and closer to the presidential election, what's going to happen is what I call presidential election year economic antics, which means the party in power does everything they can to stimulate the economy, to make it good so that people who vote with their pocketbooks, which most people do, will have something positive to think about them when it comes time to, in this instance, check the box on the ballot. Does that mean lowering of interest rates? Could be. Could it be some attempt to get a stimulus package through to actually put money into people's pockets? Could be, though I disagree with that. It's called politics. They want to remain in power. Think about that. So we've got a lot going on in the world. We don't have enough inventory in summary. And really, when you think about it, is 6% that high of an interest rate? I mean, when I started in the real estate business in 1983, I could get you a 30-year fixed rate at 18%. 6% is not bad. In a historic sense, it's actually very low historically. And once we get used to this new norm of higher interest rates, we may see buyers jump into the market with abandon. But let's reshoot that. When we think about it, is 6% a high interest rate? When I started in 1983, I could get you a 30-year fixed rate loan at 18%. Yes, ma'am, 18%. Historically, 6% is not that high. And once the buying community starts to understand that higher interest rates are the new norm, I believe they'll jump back into the market, because I don't believe the desire to own a home is going away. It just has to become the new norm. For the people that are saying the market is going to crash, don't buy it. I think it's going to be an opportunity for sellers to sell and do very well, because we're not going to see their gains that they made over the last 2 years taken away. It's actually good for buyers. For the first time in a while, they may do a little bit better. And even though the interest rates are high, if I'm wrong and they do come down, you can refinance. But if you're going to own your home in Hawaii 10 years from now, I think you'll look like a financial genius having bought in 2023. Okay? So that's my prediction. Think about it. If you want to reach out to me and disagree with me or just talk to me, feel free to do so. I can be reached at 808-398-3220. And you have a great rest of the year.